cost of ignoring the new revenue recognition standards. My name is Mary Tressel. I'll be your moderator, and I want to let everyone know that you will receive an email within 48 hours with a copy of the presentation and a link to the recording. So first of all, just in case this is your first webinar with us, I want to explain how to use your webinar pane. In your upper right-hand corner of your screen, you see a small orange arrow. You can click on that arrow to expand the box. And if you have questions for our presenters, please type it in. You can hit send on those questions at any time throughout the webinar. If we have time at the end of the presentation, we will answer questions from the audience. If not, we will send you an email with an answer, again, within a couple of days after this webinar. And then also we want to make sure you have your audio settings checked correctly. You don't want an echo sound. So if you're using your mic and speakers, please check that option. If you've called in by phone, check that option. To qualify for California continuing education credits, you need to be using a personal computer, not a smartphone, and log in with your own information and unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You also need to actively respond to at least 75% of our polling questions and complete the evaluation survey at the end of the webinar. Again, you will receive your certificate via email a couple of days after the webinar. And with that, I'd like to introduce our presenters. Today we have John Denikin. He's a partner in our financial advisory services practice. He's got over 30 years of financial executive operations and consulting experience. He's sat in your seat before, held positions such as CFO, Vice President of Finance, Treasurer, Controller, and Director of Operations. Again, we have Ricardo Martinez, CPA, presenting. He's a partner in our audit practice, and he's got more than 15 years of accounting and finance experience. He held positions with KPMG's audit group and the Global Methodology Department. He's a member of the AICPA, the CalCPA, and Provisors, and he's a proud graduate of Santa Clara University. And our last presenter is Dean Quiambo. He's a partner here at Armanino. He's spent 12 years as an auditor in Armanino's audit department. He's recently transitioned to become our chief relationship builder, and he helps numerous nonprofits and private schools address their tax, audit, and outsourced accounting needs, as well as other industries. So, and he's also a member of the MBOA, the AICPA, and CalCPA. And with that, I'm going to go ahead and turn it over to Dean.
Thanks, Mary. I hope everyone's having a great afternoon. Nothing like a 2 o'clock webinar. We'll do our best to keep everyone awake and listening. So today, during today's webinar, hopefully everyone's going to examine a prototype revenue recognition gap assessment. We'll identify the organization's holistic risk from departmental level value to the valuation of the entire company. Look at the preparedness of the internal team members to handle the new requirements and the new regulation. And lastly, hopefully give you some tips for working with your favorite, your external auditor, to streamline those audits moving forward with the new standards. So presentation overview continued. We'll look at the basics of ASC 606. I feel like we should almost put a hashtag up there and just say hashtag ASC 606, because this is such a big thing that should be trending all across accounting. We'll look at the cost, the representative revenue recognition challenges and how to account for them by industry. And lastly, like we said, we'll go through that gap assessment.
All right, and we're going to start you off with a polling question. We haven't even taught you anything yet, but we've got a question for you. So hold on, that is just launching now. And the question is, how prepared are you for the new rules? And you can check all that applies, not necessarily just one answer. So you can let us know if you've just started to think about revenue recognition rules, the changes, that you've done a gap assessment, you have a team in place, you have a software solution in place, you have a transition strategy to move from ASC 605 to 606. So we'd ask that you go ahead and register your votes on that and let us know how prepared you are. It looks like we still have a few people voting. We want to make sure you get a chance to vote and get that continuing education credit. So I think it's trending the way we thought it might trend, but let's give it another minute or two.
Answer that question so you get your credit.
All right. Okay, Brian, I think we can go ahead and close that poll. So is this a surprise to my presenters?
So we have about, what, 71% said that we're just starting to think about it, which I guess is good. And hopefully with this webinar, John and I can help you get more familiar with the changes that are coming and how it might affect your industry. Do you have any other thoughts there, John, as we look at this?
As you said, I think it's about what we would have expected. Most privately held companies really just starting to think about it. Public companies are a little further along, obviously, because they need to be live next year. But yeah, it's about what we would have expected.
Great. Okay. And with that, we're going to turn it over to Ricardo to give us the auditor's perspective.
Perfect. All right. You jump to the next slide here. All right, so we're going to talk a little bit about kind of the important dates. By now, I think you've probably heard it through various webinars. I'm sure you're all participating on, which is great. I even participate on webinars myself, just to familiarize myself with what's happening and getting up to speed and make sure I have the most relevant information so that I can communicate it as well to you all. For calendar year-end companies, the go-live date for publics are going to be January 2018. As John just kind of alluded to, and then for private companies, it'll be January of 2019. Again, this is for calendar year-end companies. If you're an off year-end, it'll be slightly delayed from those timeframes. So when we talk about a lot of the implementation dates and transition methods and the other stuff, we're kind of speaking really to calendar year-end companies. If you do have questions about the effective date for your company in particular, let us know and we can try to help you out during the session. So there is, for private companies, there is the adoption to early adopt, but that is no earlier than the date for public companies. So in this case, if you're a calendar year-end company, your go-live date would be January 2019. If you wanted to, and I haven't heard anybody yet, a private company actually wanting to adopt, although we'll talk about some of the benefits below here, you could adopt for January 2018. So the benefits is that you avoid dual reporting requirements. In other words, you don't have to worry about the transition methods. You would just basically take effect as you're kind of going through the process. And then really the benefit would be for a pre-revenue stage company to adopt now prior to revenue, and then just go through the process of utilizing 606, again, starting in January 2018. There is no earlier adoption prior to that date for private companies. Okay, so we're going to next go into the 5 steps that are required when deciding how and when to recognize revenue. So step 1 is identify a contract or contracts with a customer. And then step 2 is identify the separate performance obligations or commitments in the contract. We're going to use the term basically performance obligations. You'll hear that quite a bit throughout. That's kind of the key buzzword here when we're talking about different, if I'm translating that to current GAAP, the different elements in an arrangement. So elements essentially would equal performance obligations. Then we're going to determine the transaction price. And then step 4 is allocate the price to each of the separate performance obligations, and then recognize revenue when or as the company satisfies a performance obligation. So this typically occurs when a customer obtains control of that good or service. So we're going to use, I'm going to try to highlight, through inflection here, some of the key buzzwords that you might want to remember as part of this process. Control being a significant one, a significant concept. And again, just a reminder, if you haven't read through the entire ASC, as John or I have, I think I went to sleep a couple times as I was reading it, but I did manage to get through it. The standard is principles based, as opposed to kind of the prescriptive guidance that we typically have right now with current U.S. GAAP, and that is a significant component to remember as part of this process. Ultimately, companies should consider the substance of an arrangement. In other words, understand what you're trying to accomplish with the contract. Don't just focus on meeting certain criteria, because, as John will highlight later on, and we go through some examples, there is different perspectives that can be taken and potentially be right. considering it is principles-based. Now, we'll talk about it also as we go through this process, but my personal opinion is that, we've swung from one end of the spectrum to the other, going from current GAAP to this principles-based approach. I think we'll get back to somewhere in the middle where it's not quite 100% principles-based. I think it'll be a little more prescriptive. You're starting to see that with some of the ASUs, or accounting standard updates, that are being issued by the FASB right now. So I think we're up to 4 that have been issued, if I remember correctly. So I think we will get a little bit more guidance and clarity, particularly when it comes to different industry revenue recognition guidance. But certainly something to consider is that this is principles-based, which is different from our current GAAP.
And Ricardo, we actually have our first question, and it revolves around a fiscal year end. So if your fiscal year end is, 3/31 per se, or something like that, when do they have to be compliant if you're a private company?
Yeah, so you're essentially going to be a year delayed from that. So in this case, you would be another year 20, calendar year end 20 if you're a private company, or you're 3/31/20.
Correct.
Okay, thank you.
Okay, second polling question. And maybe it's a trick question since we just had that. But we're going to put this up here on the screen for all of you. So when are the new rules effective for private companies? I'm going to clarify this: private companies with a year end of 12/31.
With a
Correct.
calendar year
Calendar
end.
That's
Yeah,
right.
absolutely.
That's right.
So is it 2017, 2018, 2019, 2020, or you're not sure? And then we did our best to confuse you.
I'm sure we did.
All right, great. So we're getting a few people voting. I want to give you a few more moments to log in your vote. And in this instance, you are picking just one answer, not multiple answers. And Ricardo did share that answer with you. So let's see if we can get most of the audience to answer. All right, at that, I think we'll go ahead and close the poll, Brian. Thank you. And so the correct answer, Ricardo, for the calendar year end.
Yes, I did my job. Thank you. Thank you, everyone. Yes, 2019 is correct for calendar year end calendar year end private companies.
So that means we have time to get this right. Is that what we should be thinking about right now?
Very little time.
Okay, very little time.
Very
What
little time. As we'll talk about, if you want to adopt it in 2019, one of the requirements of the new regulations is you have to present the impact from all prior years that are presented. So if you're a lot of the companies we deal with, technology, software, anytime you've kind of maintenance contract, multi-year contracts, most of those contracts are already going to have to be accounted for under the new rules. So you already want to be thinking about what the effect is under the new rules, as well as the current rules. For 17 and 18, if you're a private company, you're going to report under the current rules. When you get to 19, you're going to report under the new rules, but you're going to need to either restate or at least calculate the impact of what revenue would have been under the new rules. So you're going to do this dual reporting or dual tracking method. You got to have to do here for a while. So if you're just starting to think about it, you really kind of do need to catch up, because if you have multi-year contracts, you're already under it whether you realize it or not.
Yeah, and I think just one other point to highlight too is the fact that, if you do have a service provider, obviously engage in conversations with your service provider, whether it's an auditor or whether it's a consultant. If you don't, certainly there are firms, ourselves, obviously John will talk about some of the things that he does, but we're certainly happy to help and have a conversation. But I think, to John's point, to summarize, it's imperative that you have the conversation this year with somebody. Even if it's to bounce an idea off of someone, just to understand what the effects are. One of the things that I'm doing with my clients is having conversations now so that they can speak to the board, and I can assist them in speaking with the board about the impact that that 606 may or may not have. But at least a dialogue needs to happen, and there's plenty of content out there to help you, and plenty of people that can help you, and John and I are two of those. So.
And I think, Ricardo, as an auditor, I'm sure that you're going to kind of vouch for this. Is even if you're one of those companies that 606 really has very little impact on, you're still going to need to have that evaluation for the auditors, because you're going to ask that question when you walk in the door. What is the impact, and kind of demonstrate to me
Prove
why
it.
there is no impact.
Right. That's exactly right.
So
Yeah,
you're gonna.
it is. And those are the things that, as we kind of go through this presentation, we'll highlight those areas where, depending on what industry you're in, it would make sense for you to evaluate your contracts, especially to John's point, your multi-year contracts, because those are the ones that are going to be affected and potentially have different GAAP accounting depending on the industry that you're in.
All right.
So yeah, we touched on this a little bit, the impact on investors. It is important to note that the total amount of revenue will not change under the new standard. So the total revenue you recognize was going to be the same. The timing, as you will see in some of the examples, could be very different. And good news for most companies, a lot of the revenue is going to get pulled forward, where in the past, where things would typically often deferred under the new regulations, the new rules, you're going to recognize that sooner. Which, of course, is going to have some interesting effects on financial statements, particularly when analysts or VCs, investors, look at trends over time. You're going to need to be able to really explain why your revenue suddenly shifted the way it did, because historic trends are not going to be compatible with the new regulations necessarily. So there's going to be a big swing here that you're going to need to be able to understand and be able to explain, or else people can get very, very confused about that. And things that, the estimates, variable consideration that right now often results in deferrals, things like sales incentive, discounts, warranties, now get estimated up front and recognized often up front. So that's part of what's going to pull that revenue forward is kind of that change in the variable consideration rules.
Okay, and I guess I just want to point out on these slides where we've got the impact slides, there's a lot of information. I want to make sure that everyone knows they will get a copy of these slides. We won't be reading these word for word, and Ricardo's going to pull out the highlights.
Right, and we're happy to explain these to you after in a little bit more detail on how it might affect your company, because again, there are different facts and circumstances, and as I mentioned at the beginning when I was kind of talking about the criteria, you really need to understand the substance of the arrangement rather than just trying to meet criteria. One of the points that I'd like to highlight here is VSOE. That was a very high hurdle to achieve under software revenue recognition, and oftentimes if you didn't have VSOE, you would have to defer the revenue, until the earlier the fact that you actually were able to establish VSOE, or you'd have to recognize it ratably over typically the PCS term. So now that hurdle goes away. So to John's point, he mentioned something that's quite significant here, and something that I haven't seen in my accounting career is, we're always a little bit conservative with the FASB and deferring revenue rather than giving you revenue. But really, one of the interesting facts is that with this new standard, there is the potential to recognize or accelerate the recognition of revenue, and this is one of those areas where it could do that. Now that VSOE is no longer a required objective in order to allocate the consideration, there is the potential, and I think John has an example coming up here of how that might look when you deferred something in under the new standard, how you might be able to recognize that sooner. Same thing, kind of the right to receive when and if available deliverables as a distinct, that's another big buzzword there, distinct performance obligation requiring the allocation of a portion of the transaction price. Those are pretty different compared to current GAAP. And then I think the last thing to highlight here is just the customer acquisition costs. So those kind of direct incremental costs associated with acquiring the contract are now capitalizable potentially under the new standard. So commissions is the best example of how that might work. That would be kind of considered an asset on the balance sheet. So certainly some things to consider.
One of the interesting things I found about this is when I was a CFO, when we did software, we always tried to make future deliverables, upgrades. We're always if and when available, because then you could basically ignore them for revenue purposes, and they didn't impact your revenue recognition. And the new standard changes that completely. So to the extent you have those in your current contracts as kind of your default position, you're now going to need to start valuing those. And we'll see that here in a moment. But so it could be a very, very big swing. So I have a couple of examples here that we're gonna walk through as this slide comes up. for each of the industries, we've kind of done an example. Now, admittedly, they're a little bit simplified because it's a webinar and we can't get into great complex discussions. But clearly, these can be very complex discussions. When Ricardo and I have done seminars where we've been with a live audience, we've gotten some very interesting discussions about deliverables, performance obligations, because the rules are a lot less, as Ricardo said, they're not prescriptive as opposed to, much more principles-based and not rules-based. So there's going to be a lot more discussion around what they are. But that said, let's take a quick look at a couple of examples here. Fairly typical software company sells two-year perpetual license with 2 years of support. Upgrades are if and when available, and like a lot of young companies, as Ricardo mentioned, they don't have VSOE at this point. So let's look at the revenue impact under the two rules. On the right is the current rule 605. Typically, if there's no VSOE and you've got support, ongoing PCS, you generally have to amortize that revenue over the PCS period. In my example, would be 24 months. Under the new standard, you would actually evaluate each of those 3 deliverables separately, and you need to actually go through and value those. In my example, so I assume that the software license, the company evaluated that and determined the value to be $3,000. You still have the support piece, which gets amortized. We've assumed here for simplicity that's $5,000. And the big new item is the upgrades. If and when available upgrade now gets deferred, you need to put a value on that and defer that until those deliverables, those upgrades are actually delivered. And that, you might have to split that further if you expect to have multiple upgrades. So that could be split into 2 or 3 pieces, if that's what you're going to see over the 2 years. So again, this is where you see a lot of revenue gets recognized sooner, and the allocation is very, very different under the new rules.
And I think just to highlight this, the way John has kind of presented it is a great way for companies to analyze the differences between 605 and 606, 605 being the current guidance, 606 being the new one. So as you kind of familiarize yourself with the process, I actually had a client who did something very similar to the way John's kind of set it up here, where they actually did an analysis of certain of their contracts under both standards so you could clearly see the impact on revenue recognition. So this could be a great way for companies to try to develop their evaluation on the impact of multi-year contracts that fall under or that would still be in existence under 606. Okay, real estate. All right, so real estate is another area where potentially there could be an impact by the new revenue recognition standard. I think some of the key points here, the variable consideration, which we've kind of talked about before at a high level, but variable consideration essentially requires companies to estimate the amount of consideration to which they'll be entitled to in exchange for transferring the goods or services. So performance bonuses, penalties, incentives, etc. I guess that's another area that is a substantive change from the current gap is there's going to be a significant amount of estimation potentially involved in determining the amount of revenue that's recognized at inception. So whereas it was a little bit more black and white, I would say under the current gap, under new gap, that is a significant change in the process. And then I think the first bullet point's another one too. Home builders, developers, property managers will need to determine whether there are separate performance obligations within their contracts. And John kind of mentioned this when he and I have done this type of presentation before. We have gotten into some pretty good discussions, particularly around what constitutes a performance obligation and whether or not it's distinct, right? We come back to that term distinct. So, having that conversation and identifying what is considered a performance obligation under the rules and that concept of distinct is going to be imperative for companies to understand as it relates to their contracts, particularly when it comes to the real estate industry.
Okay, we have another example from the real estate industry, or a large contract. We're going to assume that we have a contract. Could be a building. or some sort of large project. It's a $100,000 contract. We're going to really focus on the performance bonus for this example, because that's really where the big difference is. We're going to assume there's a $50,000 performance bonus with a penalty associated with it. So if the project's late, the bonus goes down. And it goes down 10% for every week of the completion is delayed. So the company's been around a long time, so they've got a pretty good handle on how they think this might play out. And you can see some probabilities here. I think 30% on time, that are completed on time, 60% 1 week late, 10% 2 weeks late. And because they've got experience, they can actually use that as the basis for their revenue recognition. Under the current standard 605, that performance bonus would be recognized when the project is delivered, and it'll be recognized at whatever that amount is. Here we're assuming that it's 1 week late. So under 605, you'd essentially recognize the revenue when it's delivered, and you get your $45,000 of revenue. Under 606, you have the option of doing what they call the most predictive approach, which essentially says that if you've got a strong history of delivering project and you have a strong basis for estimating, in this case you'd be 1 week late, you actually recognize that revenue on a date of sale. So that revenue gets pulled forward all the way to the beginning of the contract, and it's still $45,000. Alternatively, if you didn't have a strong history, you would actually have to do kind of a weighted average across those three probabilities, and you'd come up with a slightly different number, but you'd still do that weighted average and you'd still recognize it on the date of sale, or rather than deferring it. And as I note here, of course, to the extent that you actually have a different number when the project's finished, you would true that up. You might recognize a little more, a little less, depending on what the actual is. But again, this is a good example where you pull quite a bit of revenue forward under the new standard as opposed to the 605, the current standard.
Okay, so now we're going to talk a little bit about the impact to high-tech manufacturing. Again, I think a couple of key points that I wanted to highlight here is the second one on the left, which is manufacturers will need to adjust the timing of recognizing products sold through distributors. So in certain cases under current GAAP, if you were selling through a distributor, you wouldn't potentially recognize that revenue until it's actually sold to the end user because there were significant right of returns or items as such. Now that changes from a sell-through method, which is kind of the current GAAP, which is again kind of the direct to end user, to a sell-in method potentially, which is selling to the distributor directly and then recognizing the revenue upon the sale to that distributor. So that is another substantive change that could potentially happen under the current GAAP, which would accelerate revenue recognition. So the discounts and returns would affect the amount recognized, but not when that revenue is recognized. So that's why the thought process is to shift it from a sell-through method to a sell-in method. I think the other thing to highlight here as well is the first bullet on the upper right, which is the high-tech manufacturers have a new method for evaluation of performance obligations. And I forgot to mention this on the prior slide, but I mentioned this concept of distinct, which is introduced in the new standard. And performance obligation is considered distinct if it's capable of being, or the customer can benefit either on its own or together with other resources readily available, and so it has to meet the second criteria here. The promise to transfer is separately identifiable from the other promises. So it has to meet both in order for it to be considered a performance obligation, and there is potentially some subjectivity to this analysis as you're evaluating whether or not the performance obligation is distinct. And this is one of those areas where I think we did get into some discussions previously about what constitutes a distinct performance obligation.
Ricardo, we have another question, and it's basically asking, is this something that we only have to worry about at fiscal year end or quarter end? Otherwise, we would be able to look at actuals and have this quantified. How do you feel about that?
Yeah, I mean, I think it's for private companies, you only really need to analyze it during the year end. If there is some inter-sort of reporting that's evaluated, then you potentially have to analyze it during the quarters. For private companies, it kind of really depends on your reporting requirements to your board, your VC, as to what they would be expecting. So in the case of if you're a private company and you're trying to determine, how to evaluate the impact on this, I know there are some boards that potentially want some understanding at an interim period as to the effect on interim financials and what the effect is on revenue for that interim period. Others are only really concerned about the year-end time frame. So it depends. I guess it's kind of my standard auto answer.
Just one other thing to keep in mind is if you have bank debt covenants, those can obviously be materially impacted by these changes. And those reports are often quarterly or even monthly. So if you have income requirements or you have revenue requirements or you have AR requirements, all of those could be impacted by this standard change. So you may need to even go back to your bank and renegotiate those covenants because the numbers could end up being very different.
Right, and I think to John's point, you'll see it a little bit later on in the slideshow, but we're going to talk about all the other groups that are affected besides finance, accounting, that are external to the company that CFOs, VPs, finance, controllers should really be engaging in conversations with those stakeholders because they are going to be affected. John gave a great example here of the bank and the bank covenants that will need to understand the impact of the new revenue recognition standard on financial covenants. And to John's point, said it very well. In many cases, I would imagine those financial covenants will need to be adjusted in order to address potential changes in the revenue recognition standard, which drop down to maybe an EBITDA, right? Have an impact on EBITDA or other kind of reporting requirements, AR, and all that type of stuff. So. We'll get to that in a little bit, but definitely a great question.
Okay, so another example here related to manufacturing companies. So we're selling a product that's a $20,000 product. Customer has 1 year to return the product if it does not meet their needs. Not an unusual requirement. In this case, we're going to assume the vendor does not have a history of returns of the product, that they can point to a good history, but they don't expect the returns to be more than 10% of sales. They've got some idea, but they don't have the kind of history you need under current GAAP to start recognizing revenue. So what is the impact of that? Again, on the right, because returns you don't have a strong history that you can point to, generally that means revenue has to be deferred until the right of return expires. So in this case, that would be, would be a year later in my example. But under the new standard, it changes quite a bit. Because the company can at least do a good estimate of what that number would be, you would recognize, in this case, $18,000 worth of revenue, which is 90% of the revenue, and you'd actually establish a liability for the $2,000, in this case, expected returns. So you're going to get the cash, but you have a liability for what you expect the returns to be because you have to obviously pay that back out. And you'd recognize $18,000 of revenue up front. So again, this is another good example where the timing ends up being very, very different under the new standards. And I guess, Ricardo, I'd ask you, as an auditor, if I came to you and said, well, I think I've got a 10% estimate, what are you going to say to me? And what are you going to look for and how I'm going to come up with that 10% number?
It's a great question because, like I mentioned before, there's a lot of estimates that are involved here, and this is a great example of one. And so preparing the support for how you arrived at that estimate is critical, and I think that's difficult sometimes for companies to pull together and analyze or provide in an auditable format, if you will. So I think it is important for companies to understand how they arrive at the estimates to be able to support it. And
you're not just going to take my word for it that it's 10%?
I would love to. Unfortunately, can't audit by inquiry alone, so I do need to kind of corroborate it through some other auditing techniques. But yeah, great point is that we do need to understand as auditors how you arrived at those different estimates. Okay, now we're going to move on to the life sciences industries, and here I think the big points. Number one on the left, 2 types of licenses recognized under the new standard. There's a right to use concept here, which is essentially recognized at a point in time, and then there's a right to access, which is recognized. The revenue is typically recognized over time. So really trying to, again, understanding the substance of the performance obligations and what's being sold in the contract is going to be very important to understand the timing of that revenue recognition. Again, right to use being recognized at a point in time versus a right to access, which is recognized over time. We already kind of talked about the sell-through approach with distributors is going to be interesting. The royalty revenue is also considered kind of a variable form of consideration with estimates involved as well. And then when you're I guess selling your IP with sales or usage-based royalty, that's typically recognized at the latter of when the customer's sales or usage occurs, or upon satisfaction or partial satisfaction of the performance obligation to which the royalty relates. So again, what's interesting, what I've found about this, and John and I are trying to highlight this for you all, is the devil is in the details, and really truly understanding how this is going to impact your company. Sitting down with experts is going to be very important. Individuals who actually understand what is changing and how it relates to your industry, because again, as you're seeing, as we try to highlight some of the matters related to different industries, there are different effects and different considerations that companies will need to address or understand as they evaluate the impact.
And I think that these are some of the most complex contracts we run into as consultants, as auditors. These life science contracts, they can be very, very, very complex. We're talking about product, right to access patents, R&D. These can become very, 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 very complex. But despite that, we're going to try and do a fairly simplified example here anyway. So Company A, which is maybe a biotech startup, grants a right to use license to Company B, which is maybe a pharma, a big pharma, something like that. Fairly typical. Company A, the biotech, is also going to continue to perform R&D on that intellectual property. And this happens obviously very, very often because the big pharmas or big companies, they want to get the access to the IP, but they don't necessarily have the capability to do the R&D themselves. So they'll often try and do these types of contracts. Company A is going to receive an upfront payment for $20 million. They're going to get an hourly payment, paid by the hour, for the R&D services performed as that gets performed over time. And then if the product is approved by the FDA, the regulatory approval, there's going to be a $50 million bonus payment. So you've got this milestone payment tied up at the end that's going to be paid out. So let's look at how this might play out. And we kind of did a little extra slide here with a little extra analysis because of the complexity of this. Clearly, as we said, we have two performance obligations. You have the right to use license, and you have the performance of the R&D services on an ongoing basis. The Company A, the biotech, they estimate the R&D services will be about $10 million under the contract. So under the contract rate, it's going to be about $10 million. We're going to assume here, for a little bit for simplicity, that the regulatory approval is considered unlikely. If you considered it likely, you would have to do a probability-weighted estimate and bring that forward. But as we know, obtaining regulatory approval for products in the early stages of R&D for biotechs is highly suspect at best. So we're going to assume that that's unlikely. So the total transaction consideration is $30 million based on the estimates. The $20 million up front plus the $10 million of R&D. As I said, the regulatory approval is unlikely, so we essentially give that a zero value is what we're really doing here. In addition, the Company A kind of does an estimate of what the right to use license would be on a standalone basis, what the R&D services would be on a standalone basis, and you can see those values of $30 million and $20 million respectively. So essentially what you need to do under the new rules is you essentially do an allocation, and you can see how we've done this here. It's based on the relative value of the two components, two performance obligations, and you end up with the license at the end, far right, having a value of $18,000, the R&D at $12,000, or $12 million, excuse me, $18 million and $12 million, for a total contract of $30 million. So we've reallocated the revenue based on the relative fair value of the individual performance obligations. So what does the accounting look like then? So under the 605, and actually since it's the healthcare industry, it's really ASC 954-605 deals with the revenue recognition specifically for healthcare. You might end up with a scenario that looks like on the right, where it's more of a multi-element arrangement type arrangement where you've got the revenue up front for the transfer of a right to use license for $20 million. The R&Ds would be as delivered, so that'd be over time, would be an additional $10 million. That might be monthly, over 2 years, or whatever the period is. 606, based on the analysis we did, you end up with a very different analysis. You still, of course, the cash up front, the $20 million, you recognize that. You have the $18 million, which is the right to use license, the value of that, which is 18, and you end up with $2 million of deferred revenue. Then as the R&D is delivered, you're eventually going to receive a $10 million because you're going to invoice the pharmaceutical as you do the work, but you're going to slowly bring in the deferred revenue of the $2 million and the new revenue of $12 million, and essentially you're going to bring in the balance of that, the balance of the revenue. Across those two. So you end up with, again, it's an example where you end up with a very different result based on the new standard.
Okay, so now we're going to jump to the impact on professional services industry. So as we kind of mentioned at the outset, step 5 in the revenue recognition process is to recognize revenue when or as the entity satisfies a performance obligation. And I think on the previous slide we had talked about kind of 2 different perspectives. There's the right to access, which is recognized over time, and then there's a right to use, which is recognized at a point in time. So I'm going to focus a little bit on the right to access, which is kind of all encompassed here on these couple of bullets. Under the right to access, you actually have a couple of ways of measuring the progress over that time frame. One is kind of the input method, and I almost like it to maybe percent complete or long-term construction type contracts under current GAAP guidance. So you'd have kind of these different methods of measuring the progress of the revenue recognition. An input method being resources consumed, labor hours expended, costs incurred, and then there's an output method, which is maybe surveys of performance completed to date, appraisals of results achieved, time elapsed. So there are some different considerations then on how you would recognize progress towards completion when you have kind of the right to access approach, again being with the revenue being recognized over time. And then in certain cases, as you'll see on the bottom left corner, revenue is recognized upon completion, where progress can't really be estimated using this these input or output methods. Underlying all of this, though, I think is this concept of when is the asset actually transferred. And according to the guidance, this occurs when the customer obtains control of that asset. And control is going to be another kind of key buzzword that you're going to need to understand. When does that actually take place? Again, understanding the substance of your arrangements rather than just trying to meet criteria. What you'll find with this revenue recognition standard is that you're really going to have to kind of apply some good thought process. This isn't a check the box type of standard, but you're really going to have to understand what you're trying to accomplish.
So with that thought in mind, let's look at a consulting firm is maybe implementing a new accounting system. You've got some key deliverables, milestones, $50,000 in this example, completion of phase 1, $150,000 on completion of phase 2. So it's a $200,000 contract with two big deliverables. If the consulting firm has a history of completing projects like this on time and on budget, you're allowed to use that to estimate the revenue, and we're going to assume, again, for simplicity's sake, that the estimate is 12 months. So it's a one year contract with two key deliverables. So on the right, is how we might end up under 605, where you've got essentially two milestones that revenue is going to get recognized as each of those milestones are completed. But on the left, on the new standard, milestone revenue milestones are essentially just another form of variable consideration. So they're not treated any differently than any other consideration, variable consideration the firm might receive, and you essentially evaluate it up front, and based on probability of recognizing it and timing, you would recognize it accordingly. So in this case, we're going to assume, just for simplicity's sake, that it gets recognized over 12 months. And I've just done it here flat over 12 months. But as Ricardo said, in actuality, it probably wouldn't be flat. The delivery and the revenue recognition would be based on either inputs or outputs of the project. So depending on how that flows, it would probably be more likely you'd be recognizing on inputs, because that's usually an easier basis to measure. Outputs is a little harder to measure very often. So you might well be using it on the inputs, might be on your hours, time consumed, whatever. You would recognize it accordingly. So it might not be flat over 12 months like this shows, but clearly you would recognize it over the 12. You could end up recognizing it over a 12 months period instead of these two big hits of revenue in two different periods.
Okay, and then I think the last industry that we're talking about is the nonprofit industry, and while if you're solely supported by donor contributions, there really won't be any impact. But if there are other revenue streams, tuition, membership, subscriptions, products, the like, there could be a potential impact. And then also nonprofits might need to identify and capitalize costs for acquiring the contract as well.
Okay, so let's do, fairly typical, and a lot of nonprofits have membership programs. In this case, we're going to assume it's a symphony. $60 annual dues, and the members, of course, receive some benefits from that. A monthly newsletter, access maybe to the archives, free admission, and some parking. So essentially what you do, rather like multi-element arrangements today or with the new standard, is you essentially do an allocation of the $60 across the four deliverables. And in this case, you can see how that, it's kind of this simple algebra. It breaks down to the newsletter, the archives admission, the free admission, and the designated parking. Essentially, there's a straight allocation that you have, and then you recognize the revenue accordingly. Under the current standard, you'd probably recognize that annually under 958-605, which is for nonprofit revenue recognition. It's generally the way it's done. On the new standard, you would recognize a piece of it, the deferred revenue, or the newsletter you recognize monthly, 1/12 of 24 or $2,000 a month. Each of the other components, you recognize them as they're used. So as the person, members access the archives, as they use their free admission, as they use the designated parking, you'd recognize each of those components at that time. So again, it's the timing, total's the same, but it's very, very different.
Okay, and we're going to bring you back with a polling question here. So in the examples that we all shared, there's something common. So we're asking you if the amount of revenue recognized changed in any of those examples between 605 and 606. So this is true, false, or not sure answer. So again, we gave examples from many different industries, showed how the revenue was recognized under ASC 605 and then ASC 606. And we want to know, did the total amount change? So we're getting in some votes here. We're going to give you just a couple more moments. And we did get a question about the slides, and we will be sending those out a couple of days after this webinar. So we will get copies of these slides so you can use the notes.
And additionally, Mary, if you did submit a question that we haven't been able to get to, we'll follow up after the webinar and circle back.
We're running short on time, so we may not be able to answer all the questions. But with that, we're going to go ahead and close our poll. And it looks like we had 58% of the audience said false, 36% said true, and 7 were not sure. And the answer is false.
The answer is false.
You're always recognizing the same amount, it's just
correct
timing.
Yeah, and that is an important note when you're talking to for you to understand, as well as when you're talking to your investors, your board, whoever, is that the total revenue doesn't change, just the timing of it changes, potentially.
All right, and with that, John's going to talk about our revenue recognition gap assessment.
Okay, so we've spent a lot of time obviously talking about revenue because that's going to be the most obvious impact of the new standard. But there's none of the other parts of the business that you also need to be thinking about as the chief financial person, whether you're CFO, controller, whatever your title is, that this change is going to impact. Obviously, as we've talked a little bit about, analyst and investor expectations are going to be very different. That would include folks like banks. But your old history of your trends are going to be different. The timing is going to be different. And make sure the analysts and investors, your board members, your VCs, private equity groups, whatever they are, understand what those are. And you want to start educating them earlier, the better, so that they really can begin to understand us, so they're not surprised by that. Obviously, your sales department is going to be very different. You may need to think about rewriting your commission programs, how your sales reps receive commissions, if it's in any way based on revenue. That can be very different. The way you do your forecasting is going to be very different. If you have whatever spreadsheets you use, if you're using a program like Adaptive Insights to do your forecasting, you're going to need to modify those programs and systems, spreadsheets for the new way revenue is recognized. IT systems is going to be a big swing for a lot of people. As we've talked about, the timing is going to be different, but if you have multi-year contracts, you need to be thinking about that now, because how you're accounting for those contracts, you probably need to be tracking under both the old rules and the new rules today, so when it comes time to adopt the new, or really formally adopt the new standard, you've already got that information, because you will need that historic information to either restate or at least analyze the impact on your financial statements when you do adopt it. So that's your order management, your billing, your credit systems, your cost accounting systems are all going to change. These are obviously it's not an exhaustive list, but it is some of the really key items that are going to be impacted.
Yeah, and I think the point here is to have a discussion as a group, as a team, to understand first, what is the impact to your company, and then two, what other departments are going to be affected by that.
So how do you really go about this, and what do we help our clients do? So it really starts, we've talked about this a little bit, it really starts with doing a gap analysis. Essentially doing, as Ricardo said, an example, something very similar to the examples we just gave, is looking at your contracts, your accounting policy around revenue recognition, and how is it going to change, and really kind of putting a side-by-side comparison together to really understand the impact. Even if the impact is very small, you're still going to need to be able to validate or show why it's a small impact and why the revenue didn't change, but most companies will have it change. Essentially analyze the exposure to the company, really go through then as part of understanding the gap analysis and really the areas that are affected by the new standard and what needs to change. That's really kind of taking that gap analysis, as I kind of indicated, out to the rest of the company and understanding what all of those changes are. Impacts on the existing metrics you use to run your company, how you look at revenue, how you look at backlog, how you look at bookings, can all be very different under the new standards. Those are key measures that a lot of companies use, and you want to make sure that you're ahead of that so that you can be upfront and it doesn't become a surprise at the last minute. One of the things I learned sometimes painfully as a CFO is you never want to surprise the board. Mm-hmm. That's always a very bad thing, so you always want to give them as much lead time as you can. Change the contract terms and conditions, things like if and when available upgrades used to be kind of an easy give because, well, you didn't have to account for them. Now you do. So maybe you want to change those things. There might be other terms and conditions around payment terms, customer acceptance conditions, return rights, all of which you want to start rethinking how those impact your revenue recognition. And then you really need to get, and this is where why it's important to do it much sooner rather than later, is really put together a timeline and a project plan that really meets the dates of the implementation. It may seem like 2019 may seem like a long time away, but it's not. And you're going to be there before you know it. And you don't want to wake up one day and say, realize, uh-oh, I've got to do this next week, and now I'm really behind the eight ball.
All right, and we've got our last polling question for the group here before we close up on our webinar, and that is, which departments at your organization will be most affected by the new rules? Is it accounting, IT, sales, investor relations, or all of the above. So John just went over the impacts throughout the organization, and we wanted to make sure everybody was listening in and got the answer to that. Certainly accounting is going to feel a lot of pain, I imagine.
Yeah, accounting departments are feeling a lot of pain on this, yes.
All right, and we're going to give just a moment more for the group to vote. We want to make sure you get your continuing education credit. So please go ahead and log your vote in. And we will go ahead and close the poll. Thank you very much. All right, and the correct answer is all of the above. All of the departments will be affected.
Yeah, there it is, all of the above, which most people did answer is all of the above. I really think it is a very, very broad impact that people really need to understand about how it impacts the whole company.
All right. Well, thank you so much. I know we said that we weren't going to try to get too technical, but I mean, even as a CPA who hasn't done some accounting in a while, that was pretty good. That was pretty deep stuff, and I feel like we could tell by the number of questions that we have that we were not able to get to that there's definitely some uncertainty out there. So Ricardo and John and myself will be following up with all of you to see how we can help and try to give some clarity in this time of unclarity. So with that said, in conclusion, during this webinar we've covered a prototype revenue recognition gap assessment between current and future states and the identification of an organization's holistic risk as they relate to the new regulations from the departmental level, such as legal, sales, internal controls, and the finance to the valuation of the entire company.
Okay, and Dean, we do have a few questions that came in, so we won't be able to answer them all before 3 o'clock, but let's go through them as we can. So the first question here is, as a fabricator of custom products, the purchase orders, contracts awarded are estimates. Would the revenue be recognized at the initial award of the purchase order?
Under the new standard, you very well may recognize the revenue at the time of the contract. It gets very much facts and circumstances, but in the new standards, you do allow for estimating the revenue and the probability of receiving the revenue. So you may end up in a situation where you could recognize revenue. Now, if it's not real clear, if you have specific deliverables like hard products that you're going to deliver over time, you would still recognize revenue when those hard products are delivered. So you wouldn't pull that forward if you have a hard product, but you may pull up some or all of the revenue could potentially be recognized up front. But if you're a custom manufacturer, chances are you're going to recognize it as the products are delivered. So that wouldn't change. So
and any time you're using estimates, I mean, it needs to be realistic and supportable. I think I put my auditor hat on now, and you have to be able to support. It can't be, okay, well, we expect 100%. If that's realistic, great, but it does need to be supportable at any point in time. So anytime you're dealing with estimates, just keep that in mind that it does need to be realistic and supportable based on facts and not just inquiry alone.
Okay, and one more question. Can you provide some examples of how the recognition of the revenue would change on right to use versus right to access intellectual property licenses?
Yeah, so again, as we're kind of talking about, right to use versus right to access, we're talking about, at a point in time versus over time. And I think it really gets back to the example that John had gone through in terms of how much you would actually recognize if it's a right to access, how much are you recognizing over that period of time based on the input-output methods that we had kind of identified in the example versus a right to use, which is going to be, recognized at a point in time because essentially you've given that right to use that asset at a point in time is the thought process. So again, kind of depends on facts and circumstances as to how that might take effect. Again, it's just looking at it on a case-by-case basis and then determining what's the right revenue recognition related to that.
All right. Well, thank you so much for joining us this afternoon. As you can see, John, Ricardo, and Dean's contact information is up on the slide. For those of you who submitted questions and we were unable to answer because of time, we will be getting responses back out to you, and make sure that you complete that exit survey as you leave the webinar so that you can get your continuing education credit. Thank you and have a great afternoon.